Ladies and gentlemen, welcome to the Sofi Weekly Monday morning live stream. Today we have Chris Hager and Tevis joining us from Vegas, actually, where we saw an amazing report. Maybe Wall Street doesn't like it as much because there might be a little bit of write down on maybe one of our companies, but that might be fine. We'll talk about it. Chris, what did you think? What is your initial thoughts?
That was a blowout quarter, like better than I expected in pretty much. So I posted my expectations yesterday on Twitter. I think they beat on absolutely everything except for the tech platform. I haven't gone like one for one and looked at it, but like all the things that I predicted, especially that members number is just crazy. I don't think any of us saw it coming in above 700,000. Like I thought low 600,000s was possible if they had a great quarter, but this was just nuts.
Let's I'll bring up the actual report just for anyone that hasn't seen it yet. What amount of members are we talking about?
717,000 new members.
717,000. That places Steven as our winner because he guessed 600,000. So he wins by 100 and something thousand again.
Yeah, I was just telling the guys right before we went live, I was like, I don't see the point in us doing member forecasts anymore because we're always off by like over 100,000. It's been 2 quarters now, I think, that they've just crushed it.
Yeah, what I should actually do is try to find their sales and marketing. I haven't actually seen that yet because I want to do their CAC numbers, but I'll probably do that during the call.
It's really exciting, right? Because if you think about it, this is them putting in place their plan to scale members over to that 800,000 to 1 million new members per quarter that they were saying they were going to have by 2024. And so it's way easier to see the roadmap ahead over the next 6 quarters when, they add 600,000, 700,000, next quarter, we're going to be in that ballpark. Whereas, for this quarter, we were thinking, okay, profitability, we're looking at, maybe low 500,000s is the estimate, right? And it makes it much more feasible for them to have like a gradual increase going into 2024 to get to that 800,000 to 1 million, as opposed to a huge step change, which is kind of like what we were expecting.
Dude, the acceleration in all these numbers, like member numbers, accelerated growth rates, products accelerated from 43 to 45%. Galileo didn't, but still held up a good number. I think it was 7.3 million new ads. Lending products still for the last like 5 quarters has just been insane. We'll talk about originations because that came in quite good. In fact, pretty close to my expectations. However, beating on all 3 numbers, I'm pretty sure that's the thing is like, I don't even feel like we were off too much. It was just like across the board, we knew what SoFi was going to do, except they just put a little adrenaline on it.
They just did it better.
Yeah, just better. Yeah, crazy.
Sales and marketing numbers went down quarter over quarter. Not down, sorry. Overall, they went up, but in terms of per
what is it? Last quarter was 182.
Yeah. Do you know as a percentage of revenue, Chris? Because last quarter was 37% of revenue.
It is now. Oh, I didn't put revenue into my spreadsheet yet. So it's 186.7 million over whatever we had in revenue.
4 million. I'll pay 4 million more for.
It's 4 million more
members than I thought.
For an extra 150,000 new members. So anyway, I'll have to update the full spreadsheet later. But the point is that CAC went down.
Yeah. Okay. Yeah, by a long shot.
Customer acquisition cost. Yeah.
It was 182. You said.
So 180. The total sales and marketing spend was 186.7 million. Last quarter it was 182.8.
186.7. By 531 is about 35%.
So yeah, it's going down.
Yeah.
So until we get the
Q,
the 10Q, then I won't actually know how much they're spending on their Galileo section. But right now it says CAC costs are $260 if I take the same number from last quarter.
Yep, that's about what I got.
Sorry, 250.
Oh, if you take the same Galileo, so 260 is overall. Yeah. And then 250 if
George,
you
good
subtract
morning,
out.
everyone. Thank you for hosting the call. Yes, actually, in fact, I want to make sure we are up on that. Chris, can you cover looking at this amazing adjusted EBITDA? And I know that this is a what's the term, BS metric, but also very important. What did you think about the actual growth in EBITDA versus what we actually saw in GAAP net losses? While I bring up the
So
call here.
they're pretty, I guess they scale pretty similarly, because the write-downs or the adjustments are pretty linear. Actually, and if you look, our SBC went down this quarter. So SoFi's SBC, let me pull that up real quick.
In absolute terms?
In absolute terms. So it was only 62 million this quarter.
Wow.
So SBC dropped, which was another reason that GAAP improved quite a bit. That doesn't affect the EBITDA, but the EBITDA just basically means like, so adjusted EBITDA, the best way to think about it is like a very first pass at free cash flow for SoFi. So not free cash flow, but actual cash flow, because free cash flow, but for SoFi is determined a lot by fluctuations in their balance sheet. And since their balance sheet's going up, free cash flow for this quarter again is going to be down a ton because SoFi retained a bunch more loans. But kind of subtracting out all that inventory stuff, this is at a first pass what we're going to be paying or what we're going to be getting as far as cash flow. And so cash flow went up this quarter by quite a bit. In order to get to GAAP profitability, we needed a quarterly adjusted EBITDA somewhere around anywhere from 120 or 110 to 120 million. So we're really close because we gained like 20 million this quarter. You do the same thing next quarter and you're right there, which is, I know people have been worried about how are we going to bridge the gap between what we've been seeing and what they've been guiding for, which is profitability in Q4. I mean, this bridged about half that gap, and we've got half left to go. And all they'd have to do, I
Jeez.
mean, like it's we're well on our way.
Sorry, David T has just gifted 40 memberships into the channel. He's going crazy. David is by far the biggest supporter of the channel by far. So
just
thank you,
sticking on
David.
the SBC point, I'm just looking at the guidance and outlook section of the note. I'll read it out to you guys. As the company moves towards the expected GAAP net income profitability in the fourth quarter, management expects depreciation and amortization and share-based compensation expenses to increase in the mid to high single-digit percentage range in the fourth quarter relative to third quarter results. So they are expecting SBC to go up as they go into Q4.
Yeah, but that's hilarious that they still, if we go to guidance, that they expect DNA to go up and then also SBC, and they still expect GAAP profitability in Q4.
Yeah,
So,
I mean, did you see the lift in financial services contribution or
yeah,
net
7
income
million or something?
revenue? Yeah. Well, yeah, it was like up 140% or something like that. Something crazy.
Yeah, who cares? It was up 7 million quarter over quarter. I thought it was actually kind of less dramatic than I thought it would be. It was going up
Yeah, I
like
thought
20
that would be
million a quarter.
better.
It went up 7 million this quarter. And another 20 more. David, I appreciate it, but it's not needed, my friend. This is crazy. Let's talk about guidance here for a second. So, like, we've been talking about, it's been an unbelievable quarter so far. This marks the triple in the triple beat here. They increased guidance and assumes positive quarterly GAAP net income in Q3 of 2023. So once again, they are expecting great numbers. And in fact, this is even with including, according to Tevis, because I haven't read that part, depreciation and amortization is going to go up, which does affect GAAP numbers. And then so does SBC, which are expected to both grow in GAAP net income. I saw a comment saying Tevis was one of the receivers of the gifted memberships. That's funny. It caught me off guard. I was getting distracted. So Anything else that catches you guys immediately?
Man, just sticking
That
on that point, I think like them reiterating the profitability in Q4 is really what a lot of the market is looking for, especially just given what's going on. Like we were talking a couple days ago, right, about Lending Club sparking fears in the market and saying, well, it's a different macro environment and it's going to be hard for companies like SoFi. And then meanwhile, SoFi comes out and they say, hey, we're still on track to be profitable in Q4. Like I think that puts a lot of people's minds at ease. And it's a subtle thing, but it's a really big deal.
Yeah.
yeah. If you go back to the guidance, if you could. The crazy part is like if you look at the guidance on the EBITDA, they've got the original 2023 guidance. It's like 70 million less. And when you're talking about like that's an increase of like 33% overall, right? That they've just raised throughout the year based on their earlier guidance. And
That's
they
like what we used to get
outperform.
on an amazing quarter.
Yeah, exactly, right? Like anyway, it's just they're everything's trending up. I don't know. Like the only thing that at all on this report that I'm not as excited about is the tech platform revenue growth, but they made up for that with like the fact that their contribution margin increased a ton. So I
Did we
would
cover
like
that
to
yet?
see. No, we didn't yet.
Okay.
So I would like to see the revenue go up a little bit. There, it's right there. So it's kind of hard to see probably, but there we go.
So for Q3 right here, it's this. I don't know if you guys can see
The
it.
difference between those two, that's probably close enough. So the difference between the or no, it's one below. Yeah, those ones. So those are the accounts is the 137 million.
Okay, I'll
The
give you.
revenue is only about 90 million. But which is only an increase of, about 2 million over last quarter. I had hoped that would be a little bit more. I had hoped for about 92 million, but look at the contribution margin. Like it went up 15 million. So their expenses this quarter, like you can see it on the line that's in between that. Their expenses went from 70 million in the tech platform to 57 million. I know they've been guiding for like margin expansion, but that's huge margin expansion in just a single quarter. Like that's big.
Yeah, and I guess that's why they were saying they were wanting to take their contribution profit margin from like 20% into the 30s, right? So, if I'm looking across the board, this is by far their greatest amount of contribution profit. And is it also their highest? Yeah, it's also their highest revenue amount too. And I want to see that breakdown. We're only going to see that by the 10Q to see, what amounts into their each different columns for their revenue for tech platform, because there was some weird amount where they said that their what they were charging or so. Here, I'll just bring it up so I'm not guessing. um, their technology platform payments network actually resulted in them losing money last quarter, the first time ever. So before they were bringing in about 400,000 to 500,000 last quarter, it negatived out at $55,000 last quarter. I don't even know how that works. So hopefully we see that back into the positives. But yeah.
Yeah. No, this was such an excellent. I feel like we're not excited enough because this was such an excellent quarter. Like if you look long term of the company, the other thing is that like if you're paying for 717,000 new members and it takes you 12 to 18 months to pay those to get that return on the cost of or the customer acquisition cost, that means is in like 12 to 18 months we'll have recouped that entire like, but it's just the flywheel is just going, right? Like they're bringing in people like crazy. Those people are going to be adding new products and being paying back what we've paid for them in the next 12 months. So like this quarter, the fact that we added 717,000 new members means that like we had to pay for those, right? But like those members for the most part are extremely sticky. They just stick around, they get in the flywheel, even if they're just, using their debit card and maybe signing up for a credit card and they don't even take any sort of loans into the future, right? Like I'm sure so I've never taken out a loan product from SoFi, but I've been a SoFi member since 2020. I'm sure they paid off what they paid, what they paid to get me, like has
Yeah.
been paid off and then some. And now everything else is just gravy from now on for me personally, right? And I still use I use quite a few products. I use them as my primary credit card, that sort of thing. And so it's just everything on the financial side and the lending side is just seems to be going exactly according to plan. And I don't know, have we talked about the student loans yet?
Yeah, that was wild. The origination
Let's talk
number.
about originations. Even higher than I thought. I thought they were going to double, and they did more than that, ladies and gentlemen. So let me switch.
All of our expectations were somewhere between 650 and 800, and they came at what 919, I think was the number.
Yeah, something like that.
Yeah.
Which is insane.
Which, yeah, go ahead, Tavis. Sorry.
It's more than a double over last quarter. Last quarter was about 400 million, and now
Can
it's
you get originations on this sheet, or do I have to?
It
go
is. It's right. It is on the sheet. It's up a little
here,
bit.
somewhere here. Yeah.
there you go.
It's not in the balance sheet. It's up. Keep going. Still more. Right. Oh no. Next one, I think.
I don't think it's
Nope.
here.
It is. It's right there.
Right
That's
there.
it. You just scroll down, go up, but go back up. So there, Q3 2023, the top one.
Sorry, my camera is blocking it. I can't see what was there.
Oh,
My apologies.
Okay. So the interesting thing is that they said they guided for like less than half of they said they'd be at less than half once they get back to nominal kind of their normal amount. So less than half of what they originated in like Q4 of 2019, which was like 2.4 billion. So their highest quarter ever was 2.4 billion worth of student loan originations. And so like they were kind of guiding for low ones once payments resume. I can only assume like this is a big jump, right? Going from slightly under 400 million to above 900 million. I can only assume once people are actually paying, there's going to be even more incentive to refinance than there is now, because people have seen the bill, but they haven't started paying the bill yet. Well, they have now, right? But when these numbers came out back in September, they hadn't actually started paying the new bill yet. And so the fact that these jumped up to 900 million means that it's probably accurate. Like I can't imagine it being lower than say 1.1, 1.2 billion once we're actually back in the point where where repayments are happening. And then that personal loan origination number, the fact that that jumped after the huge jump last time, it's still going up.
Yeah,
and then
I did not believe that. That's crazy.
They must be adding. I haven't taken a look at the balance sheet yet. They must be adding quite a bit to it. We'll see capital ratios and all that stuff. We'll talk about it and analyze it in detail later. But the point is, like, they're taking market share. They are growing every single aspect of their business. The home loans again. So this was like the worst quarter ever in terms of home loans for the market at large. So like less mortgages were taken out in this quarter than there were since like the the GFC bubble burst, right? Like since the great financial crisis, since like mortgages were going negative all over the
And
place.
every bank slowed down their home lending. Every
single one. But SoFi increased it by what is that, 45%, give or take, quarter over quarter. Like it means that Wyndham's been fully like they've hit the ground running, and whatever they're doing, it's working because nobody else like. That's the thing about SoFi that always gets me, is that people will look at all the other banks that are reporting and they'll look at everything else and they'll say, look at all these trends that are going negative. And then SoFi just bucks the trend. And it's been doing it quarter after quarter after quarter for like a full year, where everything else in the financial segment, everything else in fintech is going down. Like pretty much revenues are either flat or negative for almost every single fintech. There's a few exceptions, right? But at large, every single fintech has been going down. Most banks have had their revenue either completely flatline or a negative. And then you look at SoFi and they're still growing at 30-40% year over year on like almost every single metric. It's like obviously they're operating in the same macro as everybody else, and it will be interesting to see what happens once they have to start selling loans, because they still haven't really needed to sell loans in order because they've still had capital available and excess capital to hold loans on the books. But it's just amazing, the execution, the amount of market share they're bringing in, the number of members, the people that are in the flywheel. It's just
can you give us
everything was above what I thought it would be.
Quick 2 minutes on if originations are accelerating like this, because this is getting very fast. Quarter over quarter went from let's talk about the last 2 quarters. 3.5 million, 4.4 million, 5 point almost 2 billion. Do we get capital constrained at this rate?
We're going to get close, right? Like, so SoFi probably in this quarter. The other thing is that as the balance book grows, the more prepayments we have, the more delinquencies we have, the more that get written off each quarter. And so so there is, at some point, once your loan's book's big enough, it can balance even with increasing originations. But we've been increasing way faster than that.
Yeah.
And so I would guess that the ratios are at the point where you'd probably feel comfortable right now. They might, if this same quarter happened again without selling loans in Q4, then they'd probably be like really close. And again, I won't know these numbers until the 10Q comes out, so this is kind of speculative. But my gut feeling from looking at those numbers and from having analyzed this in the past is that we're probably at a capital ratio of in the mid-teens to low teens at this point, maybe like 13-14%. And that's kind of where you want to be. Well, I don't know, maybe around 14%. And that's close to where you probably want to be long term, especially if we're going into a recession and there's fears about delinquencies and charge-offs and defaults and everything else. You probably don't want to get too much beyond that. So it'll be interesting. The next 2 quarters will be fascinating to see how they handle originations, whether they continue to reaccelerate and if they're able to get loans off their books, or if they have to decelerate originations in order, just because that's what they have to do to make sure that they don't, that they don't become, they don't have too many risk assets is the right way, I think, to say it.
So we don't know if they sold loans this quarter until the actual other report comes out.
Till the call, because it's just not
they'll let us
included
know.
in this, but they'll say it on the last couple of quarters. Almost every single quarter they report that, so we'll see.
So,
And I did see, or Bender found that securitization that's happening, a personal loan securitization that was filed last Friday, but there's no details on it yet. So, but we'll see.
this is, and I guess this is the hamper to maybe my biggest problem, is because I know a lot of people simply, whenever they're trying to get introduced to a new company, that they look at some sort of screener that is just showing them net losses. And I worry from a GAAP perspective that we just look worse, even though we might not be worse. You know what I mean? So this is the number that I've highlighted at the bottom that I care about. The negative 20 million almost, which was my exact prediction. And then what people are really going to see is 266 or 267 million. And that's kind of a problem, but it's not really. It's writing
It's a
off
paper
of
loss.
potential overpaying for Technisys, which in my opinion has not been as great as they were hoping. Yeah, but regardless, it doesn't change the actual financials and what we're paying for the company. It just might affect how people look at the company whenever they're looking at a chart of net losses. So I can already feel like a pain for the next 3 months of having to argue for SoFi for this metric right here. And that is why I'm like, oh, come on. But it
So
will actually make it better going forward whenever this has already been dealt with. And then we do lead into positive net income. And Q4 has always been the number that we're looking for. But
okay, so let's stick on this point because I think that this is confusing some people. We closed the acquisition of Technisys in 2022. We paid more than what Technisys is currently worth right now, and that difference is reflected here. But because the acquisition was closed basically a year ago, nothing in essence changes with regards to their actual financials of what they're reporting. And so that's why it doesn't matter. Is that a fair sort of
Goodwill is kind of a messy metric because you kind of overpay for a company, but balance sheets still have to balance. So then they create this thing called Goodwill. This is a very easy way of saying it, but they'll create this thing called Goodwill where it's like, we're paying for the brand name and we're paying for the people, and this is what it's all going to. Now, if, for example, valuations across the board, you're seeing it with SoFi, are dropping down, that means that the values for Technisys can drop down. This is exactly what happened for Amazon and for a bunch of companies where they had to write down some of their companies, like Rivian, for example, and then they see these massive losses. It's just a revaluation of something that isn't done in real time. And so this has kind of been happening in the background the whole time. We're taking it on our balance sheet today. It's not a real metric. We don't lose 266 million. We lost it whenever we bought Technisys and overpaid for the company. But now we're just really writing it down.
Yeah, so it's a paper loss, right? So if you assume we paid something like 1.1 billion for Technisys, right? When they bought it, then the goodwill on that was, I don't even remember what it was, something like, I don't know, $600 million or whatever, right? And so they're saying that's the amount of the amount of money that SoFi paid that was above or to make the balance sheet balance, like Tanner just said. And so now they're saying, well, just kidding, it was only worth 300 million instead of 600 million. And so it's this paper loss of 266 million. Also, people who follow me know that I don't care that much about GAAP net income and GAAP in general, because GAAP has some weirdness to it, and there's lots of things that don't make sense, and that, like, you can play numbers and get GAAP profits to go up or down based on accounting rules that don't always make complete sense. And so I'm completely, this isn't a thing that I'm worried about whatsoever, but Tanner's right that people are going to look at this and say,
you're going to hear about it, Chris.
Their GAAP net loss went down. Like, they lost, 400% more, or 400% more in Q3 than they did in Q2. They're becoming less profitable, blah, blah, blah.
Look at all the people that are ranting and raving. They're saying non-GAAP, which in my opinion is more important. I had an argument with Steve where he said GAAP is the only thing that's important and non-GAAP isn't. That is not true. Like
it's all about context and nuance, right? Like, in this case, it makes sense because in this case, it's just a paper write down. Sorry, I interrupted you. Go ahead.
No, go ahead.
I was just, yeah, all I'm saying is, like, it depends. So the thing about GAAP is you have to look beyond the headline number to understand what's going on underneath in order to understand, like, the GAAP numbers. And so there are times, like, if you are consistently GAAP negative, and it means that you are free cash flow negative, it means that you are burning cash, it means that you're actually losing real money and you're not growing and all these other things, then it's something to be concerned about. But if for a growth company, like, anybody who's investing in SoFi should not be investing because of GAAP net income right now. The point of investing in a company like SoFi is the fact that you think that they're growing enough so that their future earnings are going to be way, way more than what you're paying for it today. But that doesn't mean you should be that worried about what their earnings are today. Like, at least I'm not, right? Like, when you invest in growth companies, that's not something that it's not an end all be all.
Someone also brought up, I think this is important because it might also go to their reasoning for this as well. As they said, is this right here going to change SoFi getting into S&P 500 if they need 4 quarters of profitability? Well, actually, no, because we wouldn't be profitable regardless this quarter. So if the expectation was next quarter is the start of profits, then this starts our timer, right? Potentially they wrote this off now and wanted it off their books, so then they don't have to for the next 4 quarters and see potentially a breakage of net income whenever it's paper losses, for example.
Yeah, if they had to write this down, for example, so say they in Q4 and Q1 you've got positive GAAP income, and then in Q2 you do this write down instead, then it does break that number.
Yeah, but this is not.
By the way, I'm wearing my SoFi hoodie.
We've never seen it. We've never seen profitability. So
essentially,
I think the call is starting.
So this is the last quarter when they can do it without actually being profitable on the bottom line.
Yep.
And don't worry, I got the call. It's still music right now.
All right.
Yeah.
I might have to bow out
this whole time.
At some point, I'll probably have to bow out to help get kids ready for school and stuff. But we'll see when that is.
Understood. Yeah, I mean, this is the sheet that honestly there's some metrics in a company that will hold the entire stock in one place. It's going to be originations and how they're potentially talking about selling loans. It's going to be that write down for net income for a lot of new investors. We're going to see that in the chat whenever people join. They're just going to be like, how did they lose so much last quarter without doing an inkling of investigation? But But if you're a long-term investor and you've been here since, you know, the $4 ranges, or even back before, whenever we first started buying, or me, I can only speak for myself, but I started buying whenever it was $14. I'm worried about members, products, the contribution profits, and the margins for those members, the CAC metrics, which are all going down. SBC is going down. There's a bunch of different metrics here that is kind of makes this a slam dunk quarter for the long-term investor. And the call is starting.
My very first buy was actually in the 20s in January of 2021. So
Actually,
very
it's not
down
starting.
on
They
those
just said,
shares.
give us 1 second. All right, give me 1 sec then.
Did you guys
Just
see
making
that
sure you guys
financial
have that.
services increased quarter over quarter, like the percentage growth, which is interesting because they've been on a like trend of sequentially lower percentage increases for like 9 quarters or something. So
What is this for? Members?
You just had
Well,
it
it's
up.
because you're
Financial
building.
services.
It's because you're going from a smaller base, right? Like financial services was such a small base that the incremental growth was smaller just because your
Yeah,
base is getting bigger.
which makes it interesting now that it's actually going up as a percentage. It's accelerating growth.
I'm
And a lot
very,
of that
very
has to
excited.
do with the $2.9 billion in deposits, which we didn't even talk about yet. So if I added $2.9 billion in deposits, which helps both their NIM is expanding, right? Their net interest margin. Okay, we'll go to the call.
Oh, sorry. I didn't mean to cut you off. I just want to
No,
make sure we get
don't
it.
cut. That's
There's an
fine.
opportunity for questions and answers at the end.
Do we
At
have
this
volume?
time, I'd now like to turn the conference over to our host, Maura Sear from Sofi Investor Relations. Maura, please go ahead.
Thank you and good morning. Welcome to SoFi's third quarter 2023 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the Investor Relations section of our website. Our remarks today will include
I'm going to try to
forward-looking
switch
statements
over
that are based on our current
the thing
expectations
to my
and
full
forecasts
desktop, I
and
think.
involve risks and uncertainties.
Give me 1 sec. I haven't started talking. I just want to make sure. This will make things a lot better. Can you still hear it?
No.
Okay.
No, you can't hear it.
Then we're stuck here with no screenshots.
Factors that could cause these results to differ materially are described in today's press release and our most recent Form 10-K as filed with the Securities and Exchange Commission, as well as our subsequent filings made with the SEC, including our upcoming Form 10-Q. Any forward-looking statements that we make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now I'd like to turn the call over to Anthony.
Thank you and good morning, everyone. Before my formal remarks, I want to take a moment to recognize the devastating tragedy that is currently taking place in Israel, Gaza, and the surrounding regions. It's been incredibly difficult to witness the acts of terrorism and resulting war unfold over the past couple of weeks and what is sure to be tough days to come. The murder of innocent people is unacceptable in any form, and it's beyond belief that such actions are unfolding in the world today. With that, let's turn to our third quarter results. The third quarter at SoFi marked our 10th consecutive quarter of record revenue and 5th consecutive quarter of record adjusted EBITDA. We delivered strong diversified growth with record revenue and improved margins across all 3 of our business segments. Among our notable achievements in the quarter, I want to highlight 2 major milestones. First, 67% of our absolute growth in adjusted net revenue dollars was driven by the non-lending businesses, specifically the technology platform and financial services segments. And second, our financial services segment achieved positive contribution profit for the first time, making all 3 reported segments profitable while bolstering our consolidated profitability, even while we continue to invest aggressively for high levels of compounding growth for years to come. These overall results are a testament to our ability to outperform in difficult or rapidly changing environments, but also our ability to deliver on our goals and our overall mission while maintaining financial discipline and continuously setting new operational and financial records. I'm excited to share more about this quarter's notable achievements. A few key financial achievements from the third quarter include adjusted net revenue of $531 million rose 27% year over year, and importantly, all three segments recorded record revenue, and we continue to diversify the revenue composition. Adjusted EBITDA of $98 million represented a 48% incremental margin and a record 18% consolidated margin. Our financial services segment achieved positive contribution profit of $3.3 million at a 3% margin versus a $4 million loss last quarter and a $53 million loss in the year-ago quarter. Our technology platform segment had a contribution margin of 36% versus 20% in Q2 and 23% in the year-ago quarter. In our lending segment, more than 77% of our adjusted net revenue was net interest income, which grew 90% year-over-year to $265 million, nearly 2x lending directly attributable expenses of $139 million. That's to say our net interest income is now nearly 2 times greater than our expenses. Segment contribution margin improved by nearly 300 basis points sequentially to 60%. At the company level, excluding one-time items, incremental GAAP net income margin of 48% resulted in a loss of just $19.5 million versus $48 million loss last quarter and a $74 million loss in the year-ago quarter. Earnings per share loss, excluding the impact of Goodwill impairment, was 3 cents per share. Sofi Bank reported $84.8 million of GAAP net income at a 19.3% margin, representing 13% annualized return on tangible equity. We remain well on track for GAAP profitability for the overall company by Q4 and in the years that follow. From a balance sheet perspective, our unique value proposition in Sofi continues to fuel high-quality deposits that increased by a record of $2.9 billion sequentially, and we ended the quarter with nearly $15.7 billion in total deposits. Importantly, more than 90% of our consumer deposits are from sticky direct deposit customers, and 98% of our deposits are insured. Our cash and cash equivalents, excluding restricted cash, remained healthy at $2.8 billion, reinforcing our strong liquidity position. We grew tangible book value for the third consecutive quarter by a record of $68 million at the consolidated level. On a trailing 12-month basis, we generated $171 million in tangible book value growth. From a member and product perspective, we added 717,000 new members in Q3 '23, bringing total members to nearly 7 million, up 47% year-over-year, and acceleration in growth. Our highest quarter ever of new products in Q3 of 1 million brought total products to 10.4 million at quarter end, growing by 45% year-over-year. Also an acceleration with record product additions in both lending and financial services. Even with this rapid growth in members, overall products per member remains at 1.5x, reinforcing the appeal of our robust product suite and multi-product adoption by existing members. Financial services products of 8.9 million at quarter end grew by 50% year-over-year, while lending products of over 1.6 million were up 24% year-over-year. I am incredibly proud of these accomplishments and the progress achieved on our march to making Sofi a household brand name. Unaided brand awareness continues to grow as a result of successfully executing viral marketing campaigns, bolstered by key events at SoFi Stadium, improving customer satisfaction, driving word of mouth, and the result of us truly helping people get their money right. Now I'd like to spend some time touching on the segment level results and trends. Lending adjusted net revenue of $342 million grew 15% year-over-year. The personal loans business maintained its strength in the quarter with record originations up 38% from Q3 '22. Student loans, as expected, saw some increasing demand ahead of the resumption of student loan payments, marking our highest origination quarter since Q1 of 2022. Within home loans, total originations were up 46% sequentially and 64% year-over-year, despite a continued challenging rate environment for both purchase and refi. We continue to fully leverage the benefits of our bank license to drive greater economics in both our lending and financial services businesses. This has resulted in strong net interest income and sequential net interest margin expansion as lower cost deposits on our balance sheet have grown. As of the end of Q3, over 65% of our loans were funded by deposits, and our $2.9 billion of new deposits raised in the quarter were essential in funding our $5.2 billion of total originations and $2.8 billion in net loan growth in the most cost-effective way. Our lending capacity remains robust with over $27 billion in total capacity to fund loans and meet our liquidity needs, which includes our $15.7 billion of deposits, $3 billion of equity capital, and over $8.4 billion of warehouse capacity. Lastly, the bank contributes to strong growth in SoFi Money products, high-quality deposits, and great levels of engagement. This has led to higher average account balances even as average spend has increased. SoFi Money products have increased nearly 53% year-over-year to 3.1 million accounts. Given the quality of these members, with a median FICO of 743 for our direct deposit portfolio, we see ample opportunity for cross-buy. More than 50% of newly funded SoFi Money accounts are setting up direct deposit by day 30. And this account primacy, as expected, has had a significant impact on spending, which exceeded $1 billion in quarterly debit transactions volume, up 3.2x year-over-year, and represents more than $5 billion of annualized debit transaction volume. Within financial services more broadly, net revenue grew 142% year-over-year and 21% sequentially to $118 million, driven by continued strong monetization within the segment, which Chris will cover in more detail later. What is most impressive in the financial services segment is that we reached $3.3 million in contribution profit despite still spending significantly across money, credit card, and invest. Moreover, the credit card and invest businesses are still in heavy investment mode, generating significant losses at a run rate of well over $100 million annually. As they scale acquisition in order to achieve variable profitability, they'll eventually see positive contribution profit, similar to how we delivered with SoFi Money. Selection is one of our key points of differentiation across our products. During Q3, we enabled our invest members to participate in 3 initial public offerings, including the Oddity IPO, the Instacart IPO, and the ARM IPO. Providing retail investors access to IPOs at IPO prices, which was once unthinkable, is just another way we're working to help level the playing field for our members. This differentiation helps bring more people onto the platform while increasing brand awareness and member growth. We were delighted to see such high quality demand in these offerings and growth in our member base. For our technology platform, full segment revenue of $89.9 million saw a slight acceleration in growth of 6% year-over-year. Importantly, as noted previously, we expect the year-over-year growth rate in technology platform revenue to continue to accelerate into Q4 with increased contribution from new partners to the platform, along with greater product adoption among existing partners. Tech Platform's overall diversified growth strategy includes growth in new vertical segments such as B2B and traditional financial institutions, new products and geographies, and a focus on partners with large existing customer bases with more durable revenue streams and growth prospects. In Q3, Tech Platform made significant strides against this strategy, with the majority of new signed clients bringing existing customer bases and portfolios, which drives much faster time to revenue generation compared to a startup, along with a growing pipeline of joint opportunities selling combined Galileo and Technisys offerings into an expanded customer base. The demand from traditional financial institutions and new categories is the most robust that we've seen. While the lead times for winning RFPs and ensuing integrations are long, measured in many quarters, not months, the transition to modern processing and modern cores is playing out in real time the way we envisioned it would. On the product side, we continue to build and ship a diverse range of products for multiple sectors. We launched a corporate credit solution, which is designed to modernize expense management for both financial and non-financial corporations by introducing a central account with a single credit limit. In addition, we've expanded our buy now, pay later offering to allow lenders to offer it as a form of working capital loans for their small business clients, a great example of the joint Galileo and Technisys capabilities. And third, Galileo powered Experian's launch of an innovative debit card program that allows users to improve their credit scores. From a geographic perspective, we received MasterCard certification to provide our payment cards and processing services in 5 new LATAM countries. Additionally, we have continued to see great product uptake in new standalone products such as our Payments Risk Platform product, which has recently been launched to the entire financial services ecosystem, not just existing Galileo clients, as well as Connecta, our natural language AI-driven intelligent digital assistant, which provides faster resolution of customer contacts and reduced contacts per customer for our partners, as well as Sofi. I'll finish here by saying how proud I am of the team's relentless ability to not just persevere through the disruption and volatility of the financial services industry in the first 3 quarters of the year, but to deliver record results. I could not feel more blessed by our great team's ability to execute, and importantly, our more than 7 million members that have been so critical in making our vision of being a one-stop shop for all your financial needs become such an amazing reality. With that, let me turn it over to Chris for a review of the financials for the quarter and our outlook.
Thanks, Anthony. I'll take over from here.
We had a great quarter with strong growth trends across the entire business. We achieved record revenue and adjusted EBITDA despite operating in a rapidly evolving macro backdrop with notable financial services industry headwinds. I'm going to walk you through some key financial highlights for the quarter and then share some color on our financial outlook. Unless otherwise stated, I'll be referring to adjusted results for the third quarter of 2023 versus third quarter of 2022. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-Q filing, which will be made available next week. For the quarter, top-line growth remained strong as we delivered record adjusted net revenue of $531 million, up 27% year-over-year and 9% sequentially from the second quarter's record of $489 million. Adjusted EBITDA was $98 million at an 18% margin, also ahead of the prior record quarter at $77 million. This represented over 7 points of year-over-year and nearly 3 points of sequential margin improvement, demonstrating significant operating leverage across all functional expense lines. In fact, sales and marketing declined as a percentage of adjusted net revenue for the 4th consecutive quarter, with marketing intensity 349 basis points lower relative to Q3 2022. Overall, this resulted in a 48% incremental adjusted EBITDA margin year-over-year. If you look at marketing expense per new member, this quarter saw a 17% decline versus last quarter and a 32% decline versus the year-ago quarter. This is a function of increased monetization of our member base and investments made in all of our operating segments, as well as continued improvement in marketing efficiency and success of our financial services productivity loop. Our GAAP net losses were $267 million this quarter. Excluding the one-time impairment expense of $247 million, net losses would have been $19.5 million, which is a $55 million improvement year-over-year. We saw notable year-over-year leverage in stock-based compensation, with SBC dropping to 12% of adjusted net revenue versus 19% in the prior year period. Our incremental GAAP net income margin would have been 48% for the quarter, excluding the one-time Goodwill impairment expense. This is a non-cash charge that has no impact on tangible book value, which grew by $68 million to $3.3 billion. We remain committed to achieving GAAP net income profitability in Q4 2023. In terms of GAAP EPS, our reported loss of 29 cents, when adjusted to exclude the one-time impairment expense, would equate to a loss of 3 cents. Now, onto the segment level performance, where we saw a strong year-over-year growth across all 3 segments. In lending, third quarter adjusted net revenue grew 15% year-over-year to $342 million. Results were driven by a 90% year-over-year growth in our net interest income, while non-interest income was down 51%. Growth in net interest income was driven by a 113% year-over-year increase in average interest earning assets and a 244 basis point year-over-year increase in average yields, resulting in an average net interest margin of 5.99% for the quarter, which is a 13 basis point expansion year-over-year, and importantly, a 25 basis point expansion versus Q2 2023. I'd also highlight our $2.9 billion of deposit growth in the quarter, compared to the $2.8 billion of net loan growth on the balance sheet period over period. With 219 basis points of cost savings between our deposits and our warehouse facilities, this has resulted in a meaningful benefit to our net interest margin and has underscored the advantage of holding loans on the balance sheet and collecting net interest income. We expect to maintain very healthy net interest margin as a result of two things. First, the mix of funding will continue to move toward deposit funding, which is currently north of 60%. And second, we will continue to pass on benchmark rate increases for new loan originations. On the non-interest income side, Q3 originations grew 48% year over year to $5.2 billion and were driven by strong performance from all three products, even as we continued our unrelenting focus of underwriting against our stringent credit standards. We saw record volumes in our personal loans business, which grew 38% year over year and 4% sequentially to $3.9 billion. Our student loans business saw origination volume double year over year and grew notably on a sequential basis to $919 million, ahead of the resumption of payments. Home loans grew by 64% year over year and 46% sequentially. And this growth, despite continued headwinds from the current rate environment, stems from the early benefits of the integration of Wyndham Capital, which has allowed us to add deep fulfillment expertise into our tech stack and better fulfill member demand. In the third quarter, we sold portions of our personal loan and home loans portfolio. In terms of in-period sales execution levels, we sold personal loans at an execution level of 105.1%, and we sold home loans at a weighted average execution level of 100.2%. In addition, last week we executed a $100 million sale of personal loans at a 105.1% execution to the same partner who purchased personal loans in Q3, and we agreed to terms with that same partner for a $2 billion forward flow agreement at similar execution levels. We are also in the market, including in discussions with funds and accounts managed by BlackRock, with respect to a $375 million securitization at favorable execution levels, and that is expected to close mid-November. Our personal loan borrowers' weighted average income is $167,000, with a weighted average FICO score of 744. Our student loan borrowers' weighted average income is $180,000, with a weighted average FICO of 781. Our on-balance sheet delinquency rates and charge-off rates remain healthy and are still below pre-COVID levels. Our on-balance sheet 90-day personal loan delinquency rate was 48 basis points in Q3 '23, while our annualized personal loan charge-off rate was 3.44%. Our on-balance sheet 90-day student loan delinquency rate was 14 basis points in Q3 '23, while our annualized student loan charge-off rate was 38 basis points. We continue to expect very healthy performance relative to broader industry levels. The lending business delivered $204 million of contribution profit at a 60% margin, up from $181 million a year ago, which represented a 61% margin. Shifting to our tech platform, where we delivered record net revenue of $90 million in the quarter, up 6% year over year and 3% sequentially. Annual revenue growth was driven primarily by a Galileo account growth to $137 million in total. The segment delivered a contribution profit of $32 million, representing a 36% margin, up significantly quarter over quarter as we leverage investments made to integrate Galileo and Technisys and to position the segment for higher rates of diversified, durable growth going forward. We expect the technology platform segment revenue to see an acceleration in Q4 with ongoing strong margins as we leverage prior investments. Moving on to financial services, where net revenue of $118 million increased 142% year over year, with new all-time high revenue for SoFi Money and Invest, and continued strong contributions from SoFi Credit Card and Lending as a Service. Overall monetization continues to improve, with annualized revenue per product of $53, up 61% year over year versus $33 in Q3 '22, and up nearly 8% sequentially, driven by higher deposits and member spending levels in SoFi Money, greater AUM and monetizable features in SoFi Invest, and stability within SoFi Credit Card spend. We reached 8.9 million financial services products in the quarter, which is up 50% year over year, and we saw record product adds with 957,000 new products in the segment. We hit nearly 3.1 million products in SoFi Money, 2.5 million in SoFi Invest, and 3 million in Relay. For the first time, this segment reached positive contribution profit at $3.3 million for the quarter, and we continue to expect positive contribution in the segment in Q4 '23 and beyond. This is while we continue to invest aggressively against ample opportunities to rapidly grow this operating segment with attractive returns. Switching to our balance sheet, where we remain very well capitalized with ample cash and liquidity. Now more than ever, SoFi Bank reinforces our strong balance sheet and provides us with more flexibility and access to a lower cost of capital relative to alternative sources of funding. In Q3, assets grew by $2.4 billion as a result of strong growth in both student and personal loans. On the liability side of the balance sheet, we continued strong growth in deposits, reaching $15.7 billion, up $2.9 billion sequentially versus $2.7 billion in the prior quarter and $2.7 billion in Q1. Important to note that deposit growth outpaced loan growth for the third consecutive quarter, resulting in more efficient funding costs and a lower reliance on warehouse lines as we ramp the portion of loans that are funded by deposits versus other sources of capital. Because of this, we exited the quarter with $4 billion drawn on our $8.4 billion of warehouse facilities. This further highlights our strong liquidity position, particularly in this market. In terms of our regulatory capital ratios, our total capital ratio of 14.5% as of the end of the quarter remains comfortably above the regulatory minimum of 10.5%. Throughout the last 12 months, we have demonstrated the benefit of having a diversified, high-growth set of revenue streams, multiple cost-efficient sources of capital, a keen focus on underwriting high-quality credit, and a high degree of operating leverage as we scale the business. We expect those benefits to persist going forward, even in light of the existing macro backdrop. For the full year of 2023, we now expect to deliver revenue of $2.045 to $2.065 billion, above our prior guidance of $1.974 to $2.034 billion, and full year 2023 EBITDA of $386 to $396 million, above our prior guidance of $333 to $343 million. For the full year, this represents 33 to 34% adjusted net revenue growth, 19% adjusted EBITDA margins, and a 48% incremental adjusted EBITDA margin, meaning we expect to drop 48% of all incremental revenue to the bottom line, despite growing at more than 30%. In terms of depreciation and amortization and stock-based compensation expense, we expect mid to high single-digit percentage increases in the fourth quarter relative to the third quarter results. With that, let's begin the Q&A.
Thank you. We will now open the line for Q&A. Please press star followed by the number 1 if you'd like to ask a question, and ensure that your devices are muted locally when it's your turn to speak. Please limit yourself to one question only. If you'd like to ask another question, please re-enter the queue. Our first question today comes from Andrew Jeffrey of Truist. Your line is open. Please go ahead.
Hi, good morning. Thanks for taking the question.
In the third quarter,
nice
we sold
results.
portions of our personal loan and home loans portfolio. In terms of in-period sales execution levels, we sold personal loans at an execution level of 105.1%.
This is them, by the way.
And we sold home loans at a weighted average execution level of.
Okay, they fixed it.
All right, we got you.
Sorry, Andrew, go ahead.
Good. Okay, great. Thanks. Appreciate it. I wanted to ask about the decision to sell some personal loans, sort of how you arrive at the decision as to which loans you sell. And, you know, you got great execution in the quarter. Could you compare that to the marks or the assumptions for those loans that you continue to hold on the balance sheet?
Yeah, sure. Thanks for the question. So what I would say here is that we've really built a nice high quality balance sheet that's generating net interest income that's nearly 2 times the costs of our directly attributable expenses to that segment. Now, despite cutting credit and driving up quality of our loans, we are still and will continue to see a lot more opportunity to originate more high quality loans. So selling at these attractive prices at the 105.1% that I mentioned, plus having the opportunity to originate more is optimal at this point.
In terms of how the execution compares to where the loans are marked on the book, we sold at 105.1%, and the book is marked at 104.0%, which is down 10 basis points quarter over quarter, despite the weighted average coupon on the overall portfolio increasing.
Operator, next question.
Dude, this operator is gone after this call.
They're probably scrambling so hard right now.
Question?
Our next question comes from John Hecht of Jefferies. John, your line is open.
Morning, guys. Congratulations on a good quarter. I'm just wondering, you've got a resumption of growth in student lending demand. You're still growing the other products too. I'm wondering, how do we think about kind of the mix at the bank and the NIM at the bank over the next few quarters, as particularly as the student lending reverts to normal demand sequences?
Yeah, it's definitely going to play in our favor. The way I think about it is we have a pretty good hand to how we allocate capital. And we're going to allocate the capital based on what's going to give us the best balanced returns. As Chris mentioned, we've grown the balance sheet really well over the last 2 years since having the bank. It's generating an impressive amount of net interest income. It's more than covering our costs there. In the quarter, you saw that we drove 67% of our growth in absolute dollars from non-lending, from the tech platform, and from financial services. I think you should expect that type of trend to continue, in that it's balanced or skewed more towards non-lending. As we think about our balance sheet, and we think about the student loan business in particular, what I'd say is we saw exactly the trend we expected in student loans in the quarter, which was a slight bump relative to where we've been in the past. We don't expect to see a step function change in student loan originations for a couple of reasons. One, I think student loan borrowers, federal student loan borrowers, are refinancing for the two reasons we mentioned. One is saving specifically in cost relative to their current rate and getting a lower rate, and then others that are looking to lower their monthly payment, some of which are doing that at actually higher rate than they are today. And so we think that will be a slow, steady climb as people hit each month of having to pay their bill. The second factor is our decisions. We're going to be very prudent in how we allocate capital and maximize returns. And now that we have 4 effective loan platforms to allocate that capital to, it'll really be driven by the opportunity in each. The 4 being home loans, in-school loans, in-school student loans, student loan refinancing, and then personal loans. The other thing I would just mention is that we did see an acceleration in growth in the technology platform. The pipeline there is pretty visible, and it's the most robust that I've seen. It'll take quarters to answer RFPs, not months, and to integrate partners. But we made the transition in that business over a year ago, and we'll start to anniversary the tougher comps in Q4, and we'll see an acceleration in that business as well. So really strong prospects in tech platform, great trends in financial services. So think about SLR and PL being additive to growth, not the driver of growth as we go into 24.
And then the only other thing I would add, John, in terms of the actual NIM margins specifically, we are expecting those to remain very healthy throughout the remainder of the year, but we are taking a bit of a conservative approach, and that's what's currently embedded in our guidance. Reason for that is obviously as a result of increases in cost of funds and various pricing strategies, as well as a mix shift into student loan refinancing.
Thank you. Our next question today comes from Dan Dolev of Mizuho. Your line is open.
Hey guys, terrific results, really, really strong. I just have one question. We're at the end of October now. Can you maybe talk about overall trends, consumer health, everything you're seeing into the fourth quarter? There's obviously a lot of debate out there in terms of the overall health of the consumer. I'm sure you're seeing a lot of it, so would appreciate some comments on that in your business. Thank you.
He means Lending Club, by the way.
With the caveat on my comments with the fact that we are
relatively unique in that we're a secular grower, not a cyclical grower at this point. Yes, there are cycles in some of our businesses, but the vast majority of our growth is us taking market share from existing incumbents as opposed to an indication of the economy or the economic cycle. So secular growth is a driving force. That said, we continue to see really strong demand for our products and really strong consumer trends. In SoFi Money, we're seeing balances increase on a per account basis, not just new accounts adding to our deposits. We're also seeing increased spending on a per account basis, not just because we're adding new accounts. And so those are two positive underlying trends. We've also seen the quality of our deposits remain strong. 90% of our deposits are from direct deposit customers, and 98% are insured deposits, which means they're not just high quality, but they're diversified. In addition to that, our invest business continues to benefit from the growth of our member base overall and cross-buying, and we see nice trends there from an assets under management standpoint. As it relates to loans, we're seeing unprecedented demand for unsecured personal loans, and obviously we saw an uptick in student loan refinancing. I think the student loan refinancing trend that we report will be more driven by what we decide to underwrite than the actual demand. And I think you can say the same for our personal loans, which has been the case for the last 2 years. We've continued to reduce the credits that we're willing to approve, and we're seeing continued strong demand, even in higher credits and higher quality. And so, Chris, would you add anything to that?
Nope.
Thank you, Dan.
That's phenomenal.
Thank you. Our next question is from Mihir Bhatia of Bank of America. Your line is open.
Good morning. Thank you for taking my question. I wanted to ask about the technology segment. We saw a nice uptick in the contribution margin there this quarter. And I wanted to ask a couple of questions there. Just wanted to get some more details. What drove the uptick in Galileo accounts this quarter? And then on the contribution margin side, is the big investment period in that segment done at this point? Like where should you expect segments to trend? And as you grow internationally, is there a difference in the revenue or margin profile between a US account or a Latin American account that we should be just keeping in mind as we think about modeling this business out over the next few years? Thank you.
Thank you for your question. And I'll talk about the overall trends in terms of demand and account growth, and Chris will talk about the leverage that we're getting there and where we are in an investment cycle, which we've talked about the last couple of quarters. The demand within the technology platform segment is as robust as we've seen. Strategically, we pivoted away about a year and a half ago from signing up a high number of accounts each quarter that would have low volume to focusing on larger customers that were more durable and that could not just survive the economic cycle, but that also could be durable through the lack of financing in the private market. In addition to focusing on larger customers that were more durable, we started to build out other verticals such as the B2B channel. With the products that we had, they serve both B2C companies and B2B companies. In addition to that, we focused on non-financial institutions that have large customer bases and financial institutions that do have large customer bases as well to get to time to revenue much faster. We'll start to see the benefits of that slowly, gradually hit the revenue number over the next 18 to 24 months. It won't be a step function at all. I don't want to mislead anybody there, but it'll be a nice steady climb on a nice steady slope. The results of our strategic switch are really paying dividends, and right now we're in RFP stages with a number of large financial institutions. We've actually won a regional bank deal that's one component of a larger piece of their business that will come on over the next 18 to 24 months. But the pipeline is very strong on both financial institutions, incumbent banks, and non-financial institutions, as well as B2B. And so the growth prospects that we're expecting there have really started to come through in a much bigger way as many institutions are under pressure to upgrade their technology and to go after new growth opportunities. I'll let Chris talk about the expenses.
Yeah, in terms of the declining attributable costs, as well as the margin expansion that we saw at 36%, this is part in due to realizing the benefits of early investments that we've made in these businesses to push technological and product development and to integrate the two platforms. In addition, Q2 was elevated as a result of a few one-time items, including FX and country-related taxes. And then in Q3, we benefited from lower comp and benefits as a result of maxing out on payroll taxes for the year and a few other one-time items. As far as the margin profile looking ahead, you can expect continued strong margin performance as we've already made so many investments to integrate the two businesses and position the combined entity to leverage demand from a broader mix of clients with more durable revenue streams. Overall, we're expecting margins to be in the upper 20s to 30% in the near term.
Our next question comes from Kevin Barker of Piper Sandler. Your line is open.
Morning. Thanks for taking my questions. I just wanted to follow up on some of the movements on the balance sheet, particularly the loan sales. We saw, capital ratios, come down a bit, but it seems like this $2 billion forward flow agreement will relieve some of that. And also tangible equity grew $68 million. Just given these factors, where do you expect, capital ratios to drift over the next couple of quarters, particularly if we start to see a larger amount of loans come off the balance sheet due to forward flow agreements? Thank you.
Yeah, hey, Kevin. So our total capital ratio you'll see in the disclosures is 14.5%. That's 400 basis points above our 10.5% regulatory minimum. We aren't currently providing a specific outlook in that ratio, but what I would say is that there are a number of tailwinds that will help bolster our capital ratios. First, we have a growing book value. We've been growing book value for the last 5 quarters in a row and expect to sustain that going forward, particularly as we reach GAAP profitability in Q4. As you mentioned, $68 million of tangible book value growth this past quarter and 171 over the course of the last 12 months. Second, we have a robust demand and pipeline of loan buyers at solid execution levels. As I mentioned in my prepared remarks, we are selling $475 million in Q4 at a favorable execution, and we have a $2 billion forward flow lined up at favorable execution. And then third, the size of our loan book and the relatively short duration of personal loans in particular, the amortization on a quarterly basis is quite material now. Between our personal loans business and the student loan refinancing business in Q3, amortization or paydowns was $2 billion or $8 billion on an annualized basis. So those 3 factors combined are going to enable us to continue to originate high quality loans while maintaining healthy capital ratios.
The only other thing I'd add, Kevin, is in the call I mentioned the fact that some of our financial services business are still in aggressive mode of investing, and they haven't reached scale yet the way the money business has. Some of our other businesses within the financial services segment. And I mentioned that on an annualized basis, we're losing well over $100 million in a couple of those businesses. That's a discretionary expense that we could decide to be more conservative on and drive to profitability faster. The scale that we have in our member base now at over 7 million members really gives us a significant opportunity just to market to our own members in a bigger way, to help them get their money right with additional products and services that meet their needs based on the data that we have. And I can't underscore that enough. So that more than $100 million in losses from just 2 businesses annualized is also an opportunity if we need to go down that path as well.
Our next question comes from Ashwin Shirvaikar of Citigroup. Please go ahead.
Thank you, and congratulations on the quarter. I want to ask about member growth, and this is, I think, the first time in a very long time that we've seen a re-acceleration in member growth. Wanted to get down into what's driving that. Was that driven by particular member product combinations? Should we expect a sustenance of maybe a slightly higher level of member growth now? Any commentary there?
Yeah, we had a really strong quarter in member growth as well as product growth. We set a record in member growth at over 700,000 and a record in product growth with more than 1 million for the first time. I mentioned on last quarter's call that we're starting to see, and we're continuing to see this quarter, the compounding effects of everything working together across marketing and product, as well as the experience and satisfaction word of mouth. We've been focused on driving unaided brand awareness because it makes the rest of our marketing more efficient as that goes up. our performance marketing has better performance and it's much more efficient. The second thing is, as you scale your data and information, you're hopeful that you can increase marketing and maintain those levels of efficiency. And I'd say that's been the biggest shift this year, is that our marketing efficiencies have maintained as we spent more money. But clearly we're spending more dollars, but we're getting greater yield from what we're spending, and that's also a factor. But the team's just done a great job of allocating 25% of our marketing to brand building, which drives unaided brand awareness, and efficiently spending the other 75% against performance marketing. And then cross-buying continues to be very positive, reinforcing our overall one-stop shop mentality. In terms of the outlook for member growth and product growth, what I'd say is we have largely been averaging in the 400,000 range for members. I wouldn't start assuming we're going to average over 600,000 or 700,000 today. I think you could start to focus on 500,000 plus members in a quarter and keep it with a 5 handle on it. And we'll see how the quarter goes and how we're doing overall. We've really been focused on driving to profitability. And as we go into 2024, we haven't set our plans yet. So I wouldn't set this at a new level. It was an extraordinary quarter. Can we repeat this quarter? Yes, but I wouldn't plan on it. So I'd keep the outlook for members in the 500,000 range for now.
The next question today comes from
Used to be
Jeff
400.
Adelson of Morgan Stanley. Please go ahead.
Hey, good morning. Thanks for taking my questions, guys. So I think just looking at the guidance for the full year, it looks like, 4Q 23, looks like you're looking for something like a 28% to 32% revenue growth exit rate for the year. Just thinking through next year, I know it's early still, but if rates stay where they are, these elevated levels, is that a good number to be thinking about for next year? Or is there any reason it shouldn't stay where it is? And how should we be thinking about the different revenue components? Should we be seeing, continued strength in the NII, a little bit less in the fee income, maybe a little bit more in tech platform? And then Chris, if I could just ask really quick on the $100 million of loans, I think you said you sold at 105.1. Is that an unhedged or hedged number? And could you just maybe speak quickly to what those loans were? Were they more seasoned or more new originations? Thanks.
That's hedged.
It's a good question.
Thanks for the questions. The first thing I'd say is the opportunity we have to drive growth is significant. We can drive compounding growth for years, given how large these markets are and our low level of market share. What we choose to grow in 2024 will be a function of the environment as we get through the fourth quarter and where things sit in January. So we take an approach that we give full year guidance at the beginning of the year after we report Q4. So we'll do that again, and then we'll update you each quarter. So I don't want to dig into the details of 2024 because there's a lot left to be decided in 23 as well as in January. Clearly, the Fed has some tough decisions to make, and that could impact the year. So I don't want to make any assumptions on where rates are, especially using a scenario where they're flat versus where they could be up 25 or even 50 basis points as we start the new year. But suffice it to say, the growth opportunities in front of us are quite significant, and we can use a lot of different levers to drive that growth. The one thing I will say as we look into 2024, to reiterate what I said earlier, 67% of the growth in absolute dollars in revenue year over year were from non-lending businesses. As you go into 2024, you should assume that personal loans and student loans will be additive to growth, not the drivers of growth. Our technology platform business and our financial services segment business will be the drivers of growth, and we'll supplement that on the lending side. In addition to that, we're committed to GAAP profitability in the fourth quarter of 2023 and for the full year of 2024. So those are two guideposts to think about. And then the last thing I'd say is we're really focused on tangible book value growth. On the trailing 12-month basis, in my remarks and in Chris's, we talked about driving over $170 million of tangible book value growth. We're just getting started there. So that's another pillar you can think about.
Yeah, and then Jeff, in terms of your question about the $100 million sale in Q4, that was at 105.1% on an unhedged basis. In terms of the actual pool of loans that we sold, we'll get into more details on loan sales in our next quarterly call, specifically as they relate to Q4. But what I would say is that it's generally reflective of the overall portfolio. This specific pool had slightly higher weighted average coupon than the average. but there were other offsetting inputs as well to it. So it's a blend, but we don't talk about the specific loan pools that we're selling.
The next question in the queue comes from Michael Ng of Goldman Sachs. Your line is open.
Hey, good morning. I just have two questions, one for Anthony and one for Chris. First, Anthony, on just sales and marketing efficiency per new member, I wanted to follow up on our earlier question, which was just around that point. Anything you could tell us about in terms of like, how sales and marketing per new member is becoming more efficient? Do you see continued opportunities to drive efficiency and effectiveness there? And then for Chris, I wanted to ask about the discount rate changes for personal loans and student loans relative to last quarter. I think the PL discount rate went up by 50 basis points. Student loans went up by 40 basis points. Any color there in terms of that increase in the context of how benchmark rates have changed and any other key factors? Thank you.
On the sales and marketing side, there are many factors that are driving efficiency, but I'm going to just focus on the big macro factor. There are others that are much more detailed. Over the long term, as we drive unaided brand awareness higher, all the rest of the money that we spend will be more efficient. If people know the brand, if they trust the brand, and we're a household brand name, the promotions we do will have a higher click-through rate. The conversion that we have to new customers and new products will also have a greater efficiency. And so as we scale the business and scale the unaided brand awareness, those would be the two macro drivers. There are many other factors in there tied to data and channels and additional technologies like artificial intelligence and other algorithms that we have, and for retargeting, et cetera. But the biggest factor is going to be unaided brand awareness and the scale that we have.
And then in terms of the underlying inputs of our marks and the discount rate moves specifically, I'll hit on both PL and SLR and some of the movements there. So in Q3, the fair market value mark on our PL loans decreased from 104.1% to 104.0%, so it's down 10 basis points. That was a function of the discount rate increasing by 50 basis points. Embedded in that discount rate assumption was that benchmark rates increased 17 basis points. That's a 2-year swap. And then spread assumptions widened by about 33 basis points. And then we had CPRs increasing, and collectively those were offset by a 20 basis point increase in the weighted average coupon. The one thing that's important to note in the personal loans business is that our actual CDR rates realized in Q3 were 3.44% versus an assumed 4.6% embedded in the marks. So that means what we're actually observing in terms of losses are about 116 basis points per year or 175 basis points over the life of the loan, below what is actually embedded in the 104.0% mark. And then within SLR, the fair market value mark of our student loans decreased from 101.9% to 101.4%. That was down 50 basis points. And that was a function of the discount rate increasing by 40 basis points. Our benchmark rates increased by about 35 basis points, and then spread assumptions widened slightly. This was offset by a 30 basis point increase in WAC, and prepayment rates ended up decreasing by about 10 basis points.
Next in the queue, we have a question from Dominic Gabriel of Oppenheimer. Please go ahead.
Hey, good morning. Thanks so much for taking my question. I was just curious about, if the environment stays roughly the way it is today for demand for your products, on the origination side in particular, how should we be thinking about the current level of personal loans versus the current level of student loans? And I only ask because given where the quarter went, it feels like you could actually see an acceleration of revenue growth next year. And so I was just curious how you're feeling about, the demand for your products and the current level and market penetration rate that you have in these products. Thanks so much.
What a no-brainer question from Gabriel.
I can appreciate your enthusiasm. And if we wanted to accelerate revenue growth for next year, we absolutely could. given how low our market share is in all these different businesses. But under this scenario where you have higher for longer, I think we all need to be realistic of what that means for the industry. The demand for our products and higher for longer, as you mentioned, will continue to be robust, and the opportunity for us to capture that will also be very strong. But we can't just think about SoFi, we also have to think about the other market participants. I do think higher for longer will absolutely put pressure on other financial companies that, unlike SoFi, are not benefiting from growing deposits and that face notable interest rate risk because they either don't hedge or they lack the ability to pass on higher rates the way that we are able to. And those are two really important points. It allows us to manage our assets and liabilities in real time and to do it at a micro level down to the loan level. Higher for longer could put pressure on these other financial companies, and in that environment, we would want to be a lot more conservative and actually see something like personal loans not grow very much at all and student loans grow marginally. And so as we think about higher for longer, we think about being very balanced, not because of the opportunity in front of us, but because of the turmoil that may happen around us. As I said earlier, think about personal loans and student loans being additive to growth and the tech platform and the financial services segments being the driver of growth. Those are low capital businesses, in fact, nearly capital free. I've also hit the point of profitability, which allows us to step on the gas to drive even more scale in them. We haven't talked about it yet on the call, but it was not an easy progress over the last 6 years in which we invested heavily in SoFi Money, SoFi Invest, SoFi Credit Card, SoFi Relay, our Lantern product, our at work business, and a number of other businesses that are in that financial services segment. For it to go from a loss of over $50 million a year ago to positive profit on a contribution basis of $3 million this year gives us license to grow that in a much bigger way because we don't absorb losses the way we were previously. We're still losing quite a bit of money and invest in credit card given their investment modes, but we can really step on the gas and on the other products to drive great scale and profitability there. So it's a great option for us to have. But higher for longer may not be the scenario for next year. But if you actually believe that's the scenario, we're gonna be conservative. We're still gonna have really strong growth, but we'll be very balanced, especially on the origination side.
Thank you. Our final question today comes from Vincent Caintic of Stephens. Please go ahead.
Hi, good morning. Thanks for taking my questions. And it's great to hear the positive reiteration of positive GAAP net income in the fourth quarter. Just wondering, when we look forward on that trend, and you've talked about revenues accelerating, increased efficiencies of the business. So should we expect the profitability of the business to actually continue to accelerate from here, or are there investments or something else that you'd like to make in the meantime, and how we should anticipate that profitability? Thank you.
TGL?
Right. Obviously, in the fourth quarter, we're expecting the profitability to increase since we go from not generating positive GAAP earnings to generating positive GAAP earnings for the first time. We're committed to generating positive GAAP earnings for all of 2024. We're still in investment mode, but we have to balance growth versus investment. I would think about what we talked about earlier this year from an investment standpoint, that will focus on 30% incremental EBITDA margins and 20% incremental GAAP net income margins as a guiding factor in how much will drop to the bottom line versus reinvest in the business. Obviously, this year, we've been well ahead of the 30% incremental EBITDA margin while still maintaining growth. In fact, what I'd say is I can't find another company that's driven the level of consistent growth that we have in revenue, as well as our member base and product base, while driving such significant improvement in profitability and building a high quality deposit and funding base and diversifying it, in addition to growing tangible book value by the level that I mentioned. We'll continue to make sure that we balance growth versus profitability next year, and we're committed to GAAP profitability for the full year in that 30% incremental EBITDA margin and 20% GAAP net income margin at a minimum.
Thank you. We have no further questions in the queue, so I'll turn the call back over to Anthony Noto for any closing remarks.
Thank you for your questions. I want to end with the following outlook. I remain confident that no company is better positioned than SoFi to be the winner that takes most in the digital transformation of financial services. building the technology capabilities to offer our complete suite of financial products all on your mobile phone and to support our scale of over 10 million products and over $2 billion in run rate annual revenue has proven to be a daunting challenge. A daunting challenge not just for the most well-equipped incumbent banks and financial institutions, but also for the most innovative entrepreneurs. Add to that the regulatory requirements and sizable financial capital and resources required, and it's fair to conclude SoFi is in a class of one. I could not be prouder of our SoFi team for getting us to this point, and thankful to our more than 7 million members whose lives we impact every day. Thank you for your time, and I look forward to addressing you again next quarter.
This concludes today's.
I can't hear anything you're saying, dude.
Oh, come on. I was going on. SoFi is in a class of one. That is so exciting, dude. Oh my gosh. Like, it's true though. Whenever you think about the competitors, what the banks are seeing, what Lending Club is seeing, what all of these companies are seeing, and then SoFi continues to push out selling loans, committed capital. That's why the stock started to run, by the way. That answered a big question for people.
Which one did? Oh, the committed capital.
Oh, sorry. I'll turn your mic down if you're echoing. Yeah, the committed capital is amazing. But I think that he answered that question correctly, that higher for longer is still painful. Although SoFi's doing things that other companies haven't been able to do, it still is a big strain on the business. Like, I did think that was interesting that he said that, we are going to have to lean on parts of the tech platform and financial services where the capital need is next to nothing. And so we can kind of get growth out of nothing while still, hopefully getting lending. I wanted to say something and then I'll let you say your part. But one thing that I think is so exciting is last quarter, it felt like in the quarter before that, it felt like we kind of were pushing the date of when the big quarter is going to be for SoFi. I think it's clear that this is still Q4. Next quarter is still the big quarter. This is when financial services will take off. This is when tech platform is supposed to accelerate growth and RFPs are coming to a close. This is whenever, lending and all these things, net income, Q4 continues to be the big quarter. Very, very excited about that. Already, I saw an article that Ken Megan had posted. Reuters posted an article saying SoFi Technologies up on higher Q3 losses. Or despite higher Q3 losses. I'm telling you, that will be the big highlight for the quarter. People are not going to understand this.
Yeah. I mean, look, I think regardless, the main takeaway here for me is that they alleviated a lot of uncertainties that the market had around the future of the business, whether it is with regards to loan sales or higher for longer or sustained profitability, or even just as simply reaffirming the Q4 profitability point, right? So, they provided guidance on all of those points. The market knows that they're going to sell loans at least 475, million in Q4. They have committed capital for 2 billion. They answered the Lending Club question, which is basically saying like, oh, others are saying it's going to be a tough environment. What do you think? They're like, we're going to be fine. Noto's going to go and have his same talk track on CNBC, on Yahoo Finance. The member numbers speak for themselves. Like the top line numbers are all good. I think the write-offs are not going to make as big of an impact. Yeah, sure, there's going to be some hit pieces that are going to lean into those, but at the same time, it's tough to find like solid negatives around this quarter. And if the biggest negative for this quarter is a write-off for an acquisition that we made last year, I will take that any day of the week.
Yeah. I thought it was really cool. There were a couple things in there that I thought were really, really exciting. However, we're going to need to go back. Whenever listening to calls, it's not the optimal way that I like to take in an earnings call because you miss so many numbers, right? Or at least I do. So hopefully I get the transcript soon. Koifin's pretty quick. Usually it takes about 2 hours or so. And then once I have that, I'll be able to go through it later on. As always, we got the FinTech Frenzy tonight at 8:30 p.m. Eastern Standard Time. This is where we go over all the biggest FinTech news. It's going to be all SoFi. I'll just be honest. There's so many amazing lines that they said here, though. Like, increased spending on a per account basis was so exciting to hear because it means that we're going to be more profitable on SoFi Money per account. And that's also while adding, like, how many money accounts did they add this quarter? It was like, here, let me check. Like, I'll bring up my spreadsheet. Actually, I've been filling it in a little bit while we were chatting.
Yeah, I was like also struggling to take notes as they were speaking. I think my entire flight home is going to be just working on a script for the actual recap video.
Here, let me do this, and then we'll go like, why don't we just do year over year? So, yeah, massive acceleration in members. They said, don't think that we're going to continue to hold up 700,000. There was key events that happened at SoFi Stadium, Taylor Swift.
Yeah, look at the products per member number. That's interesting to me. I mean, Noto said we're still at 1.5, but that's been sort of decreasing every quarter.
Yeah, and he said it'll be a long time until that starts to increase. I thought that we were going to see a slower amount of member increases, and so products per member was going to increase.
Right.
But no, that didn't happen. That's still, members are growing at such a high rate.
And it's just like you can't even feel bad about members growing that fast, because the flip side or the bear case about members growing fast is higher S&M spend. And if S&M is only $4 million higher, for that many members, like, CAC cost is down as a result of it. The spend as a percentage is down, and like you can't even point to the member count being higher to say, oh, it's going to hurt their profitability. It's not.
Yeah. So Brooks is saying, Tanner, look at chat. So from what I heard, they're selling $375 million of loans to BlackRock. I have to go back to see what rate it was. I think I missed the rate at what they're selling it at. That's why the transcriptions will do us big favors.
Yeah.
One of the things that they said, they had $2 billion of committed capital, which will be exciting. That's whenever the stock started to raise, because that answers a massive question for us.
Yeah. The capital ratio at 14.5%, 4% above the 10% minimum requirement.
Yeah. One of the things, but it's down quarter over quarter. One of the things that was also a little bit, I mean, it was good, but it wasn't great, is that it answered a question that they said unhedged, we were selling loans at 105.2%, which is great because Lending Club actually sold at like 98% for some of their loans. Oh, let me plug in my camera. But what was I going to say? Sorry, my camera's going to die here in a second. All right, I'm good. That they said that they sold it at a higher coupon rate than their overall book value, or sorry, their overall coupon rate for their book, which means they sold these very good loans, very, very good loans. So we'll have to see, how investors actually take that, because that's not the average quality of our book. That's, hand-picked loans, but whatever. One thing that's quite cool, this is a new metric that I'm starting to show off, is a percentage of new products that lending continues to go down to 8.6% of the total amount of products that were actually brought on were lending products, which is going to increase the, the lean on financial service products at 91.4% now. And so that's quite exciting. We almost are about to hit 1 million new products in financial services alone. That'll probably happen next quarter. Well, maybe not next quarter, but
we hit a couple of milestones. I think we crossed 10 million on the product side.
In a quarter.
Yeah.
Or sorry, not in a quarter. Sorry, 10 million total.
Yeah,
1 million in a quarter.
Yeah, 1 million in a quarter. Yeah, and just on the loan side, man, all three segments increasing the highest. I think he was saying like the highest origination quarter they've ever had, or since Q1 2022, and all of that since Q1 2022 for student loans, and all of that is just high rate environment for home loans, ahead of resumption of payments for student loans, and then personal loans still going up despite the just gigantic amount that they already had.
370,000 new SoFi Money accounts. Makes up for a total of 35.4% of new product ads and 29% total. And I wanted to see Relay or SoFi Insights, how many they added. 405,000 new Relay accounts, making up for 38.7% of new product ads. That's crazy. Absolutely crazy. Such a big product for us, which cross-sells, hopefully, into many, many new products. So although it's not revenue now, it's revenue, data, and insights into the future. Quite interesting. We'll have to go through a lot more of these numbers whenever we do the FinTech Frenzy. But
yeah, no stock tank today.
No stock tank.
Probably next week. I think I have a guest for next week, but we can talk about it offline.
Anything else? Dude. Tanner. CAC. CAC went down. I won't know from the 10Q how much they actually spent on the technology platform. Right now, I have it placed at $250 per person. Just from Q1 of 2022, that was $384. That went down to $298, and now that went down again to $250. So it's falling off a cliff.
Tanner, I sent you this on the private chat. Can you throw it up on screen, please? Yes. It's the BlackRock deal. Since people in the chat are talking about it, this is the business wire.
Oops. SoFi and BlackRock partner on $375 million personal loan securitization.
Yeah, maybe we can go through this.
Yeah, this is going to make for good TV. Tevis?
Yeah, I mean, just talking about that on
yeah, we'll go through this later.
And like, again, this is all going to be in the talk track, right? Around all the networks that Noto is going to be visiting today. So it's a big deal, right? Them selling loans was like a question mark, and they seem to have put a lot of analysts' concerns at ease.
Yeah, 4 a.m. in Vegas right now. The dedication. I know. And he was up late last night as well, I'm pretty sure. So Tevis wanted to be here. I love it. One thing I do want to add to people, okay, because I don't want any amount of excitement to be underestimated. 700,000 members does not translate into revenue this quarter, especially whenever you're adding on SoFi Relay and Money members. Whenever you see those are the top of funnel customers that you absolutely want. It brings customer acquisition costs down, and then it makes for whenever they cross-sell into student loans or personal loans or home loans later down the line, those become customers that we only paid for a tiny amount through financial services. This is the exact example of the financial services productivity loop that SoFi is trying to talk about, okay? It's doing everything that we're expecting it to do. We are on pace to do exactly what SoFi has anticipated. Since I've been investing, this is another slam dunk, like all the check marks for SoFi. There are small indications that there's weakness, okay, in terms of, just because it's a bad macro environment, that loans might be slowing down. But guys, whenever this ship turns around, this is an instant boom in the stock price. So I'm telling you right now, don't worry about stock price. This is a long-term hold. Please have longer expectations than a single quarter. It will turn around. At least, I mean, I can't say that. That's not, but if things hold up this trend, investors will be more keen to invest in a company that's growing this fast.
I just think that this also, like, obviously macro dependent, but like this should form higher bases for us. If I say this time and again, right? The longer that the bear cases get broken down, or the longer that time passes, the bear cases get broken down, and that forms higher basis for the stock price, right? Because like this is gonna like Noto's gonna go on all the networks. We're gonna make recap videos. More stuff is gonna be found in the 10Q that comes out next week, right? Analyst upgrades are coming in the next couple of days, or even as early as today. I guarantee you, mark my words, by the end of the trading day, Dan Dolev will have already upgraded SoFi. Like he's already typing up the note right now, guys. Like I guarantee you. And so my point is like, SoFi traded under $7, but as more of this news comes to light, as we understand the nuances and we get confirmation that the bear cases have been broken down, then really what are a lot of the negatives around SoFi? A lot of them might be macro driven. A lot of them, like, what are you going to say? The Goodwill impairment? Like, come on, let's get real. And so I think that a new higher base will form that will lead to a double-digit price going into Q4 earnings, and then accelerate from there, right? As we expect profitability, then the question becomes like, hey, can we sustain these higher new member counts, S&P inclusion? Like it's looking up from here because this earnings call answered so many of the outstanding questions that investors had.
Yeah. I think that, like Lee is saying, the tech news was massive. I think, and I don't know what exact tech news he's talking about, but I think the most important news that we saw from the tech platform as well is that margins should stay high, like they just made a massive improvement in margins. That should stay similar going forward. That will be very, very exciting for the technology platform. There were so many little insights that we heard in that call, and that is on this actual report that I'm going to have to go through before the end of the day. Guys, it's earnings season. I'm getting super excited. We got PayPal next up. We got Shopify, Airbnb, Nubank coming up, a whole bunch of them. We're going to have a ton of fun. But yeah, ladies and gentlemen, Tevis, do you have anything else to say, or are we wrapping?
Nothing else to add. Let's wrap. Congrats to all the SoFi bulls. Enjoy your day. Regardless of what the stock price momentum is today, whether it's up 20% or it fades away, who cares really? The company's executing and they're going to go higher. And there's really not a lot of negatives on the horizon that you can think of for the stock. So have a cup half full attitude, everybody. And thanks again for watching early in the morning.
Bye. Get out of here. Go do something else with your day. Peace.